If you learned investing from books written in the 80s or 90s, there's a good chance you're following rules that don't work anymore. Rules like just buy and hold forever. Diversification always reduces risk. Stocks return 10% per year. The 60-40 portfolio is safe. These rules used to work. But the market structure has changed. Interest rates changed. Technology changed. Information speed changed. And quietly, some of the safest investing advice became outdated. Today, I'm breaking down 5 investing rules that stopped working and what replaced them. Rule 1: buy and hold forever. Buy great companies and never sell. That philosophy came largely from investors like Warren Buffett, and historically, it worked beautifully. But here's what changed. In the 20th century, companies lasted decades. Competition moved slower. Innovation cycles were long. Today, entire industries get disrupted in 5 to 10 years. Think about how. Physical retail was crushed by e-commerce. Cable TV got replaced by streaming. Taxis got disrupted by ride-sharing. The average lifespan of companies in major indexes has dramatically shortened. Buy and hold still works, but only if the business adapts. The new rule is buy and monitor, hold conditionally. If the moat weakens, you reassess. Blind loyalty is not a strategy anymore. Rule number: diversification always reduces risk. You've heard this 1,000 times. Diversify to reduce risk. But here's the part no one mentions. In market crashes, correlations go to 1. When panic hits, stocks fall together. Sectors fall together. Even international markets fall together. In 2008, in 2020, in rate hike cycles. Owning 30 stocks doesn't protect you. If they all move in the same direction. Modern markets are highly interconnected because ETF flows, algorithmic trading links sectors, global liquidity drives everything. Diversification reduces single company risk. It does not eliminate systemic risk. The updated rule: diversify across risk drivers, not just tickers. Different asset classes. Different economic sensitivities. Different time horizons. Not just more stocks. Rule 3. The 60-40 portfolio is safe. For decades, the classic portfolio was 60% stocks, bonds. When stocks dropped, bonds rose. But that relationship depended on one key thing: falling interest rates. From the 1980s until recently, we lived in a declining rate environment. That made bonds a perfect hedge. Then inflation returned. And something unusual happened. Stocks fell. Bonds fell. Together. The assumption that bonds always protect equity risk broke down. This isn't permanent, but it proved something important. The 60-40 strategy was built for a specific macro regime. And regimes change. The modern rule: understand what environment your strategy was designed for. Interest rate regime matters more than allocation formulas. Institutions watch signals from the Federal Reserve more than they watch simple ratios. Retail investors should too. Rule 4. Stocks return 8 to 10% per year. This one is subtle. Yes, historically, broad U.S. equities averaged around 8–10%. But that includes massive expansion in valuations, falling interest rates, globalization tailwinds, strong demographic growth. Future returns depend on starting valuation, earnings growth, macro conditions. If you buy when valuations are stretched, your forward returns compress. This is basic math. The danger of assuming 10% returns: you might undersave. You might overleverage. You might take risks you don't need to take. The smarter mindset: expected returns are conditional, not guaranteed. History gives context, not promises. Rule 5. The market is efficient. This idea comes from modern portfolio theory. Prices reflect all available information. But today's market is dominated by passive flows, index rebalancing, momentum-driven strategies, retail option activity. Sometimes price moves have more to do with flows than fundamentals. We've seen meme stock surges, extreme short squeezes, sector rotations driven by positioning. The market is efficient long term, but short and medium term. Flows matter. Liquidity matters. Positioning matters. The updated rule: understand behavior, not just balance sheets. Studying psychology can be as important as studying earnings reports. Here's the big takeaway. Most investing rules aren't wrong. They were just built for a different environment. The biggest risk in investing isn't volatility. It's applying old assumptions to a new system. Markets evolve. Technology evolves. Liquidity regimes evolve. Your strategy should evolve too. If you want to outperform long-term, don't just ask, what worked? Ask, why did it work, and does that condition still exist? That question alone puts you ahead of most investors.